We have anticipated for some time a substantial slowing in our economy.
While inflation might have already passed its peak, this year new challenges are set to test us.
With more than a decade of investing in commercial properties under my belt, I've weathered my fair share of economic storms. But this latest period of global uncertainty feels different, more unpredictable. We've got supply chain disruptions, geopolitical tensions, the aftermath of COVID-19, and the RBA's aggressive rate hikes. The commercial property landscape looks increasingly risky. Falling transaction volumes, rising vacancy rates, and growing capital uncertainty have many investors questioning where to safely put their money. So I've spent over 50 hours researching the market to find pockets of stability. What I found was not what I expected, and I think it'll take you by surprise too. Neighbourhood retail centres. Not the major grocery or shopping centre chains, but those small community spots that offer the essentials. And in this video, I'm going to show you why, despite the economic roller coaster, investing in neighbourhood retail might just be the smart move you're looking for. Traditionally, city centres where the action was for retail, but with more people working from home and the surge in online shopping during COVID, physical stores have taken a hit. In the Asia Pacific region, retail rents fell by 16% more than office space rents in the first half of 2020. And the thing is, these aren't just temporary changes. They're reshaping the way we shop, potentially for good. With the shift towards remote work and online shopping, traditional retail spaces might not hold the same value they once did. So that begs the question, what is the future role of in-person retail? Are there still smart brick and mortar investment plays out there? That's the million-dollar question as we try to navigate through this uncertainty. A recent study looked into how economic uncertainty is shaking up the Australian retail rents, focusing on different types of shopping centres. For clarification, regional centres are the big fish, with a mix of department stores, supermarkets, and lots of specialty shops. Sub-regional centres are a bit smaller, with a supermarket and around 40 specialty stores. Neighbourhood centres are the smallest, serving local communities with a supermarket and less than about 35 specialty shops. Now, to dig into how uncertainty has actually impacted retail rents, this study analysed a huge data set. We're talking quarterly rental data all the way from 2000 to mid-2022. On top of that, they factored in economic policy uncertainty using an index that tracks things like news coverage and tax changes. This captures uncertainty from political events. And they incorporated control variables, metrics like consumer prices, GDP, unemployment rates, and real estate prices. This paints the full economic picture. And by assessing the influence on uncertainty on rents across different centres, we get insight on how quickly the different subclasses respond to these shocks through rent changes, and 2, the overall resilience across each type of centre. Take a look at this. From these graphs, you can see that retail rents generally move opposite to uncertainty. When uncertainty spikes from some external shock, rents decline. But here's the thing, it takes about 2 quarters or 6 months for that shock to actually transmit through the property market and impact rents. So in the short run, rents drop across regional, sub-regional, and neighbourhood centres. Everyone feels the initial sting. But regional proves more resilient overall in the short term. The rents don't fall as hard, even though uncertainty is high. Over time though, these subclasses recover at very different speeds as uncertainty eventually stabilises. Regional centres bounce back in about 4 years. Sub-regional takes over 5 years to recover. But here's the crazy thing, neighbourhood centres rebound in just 1 year. 1 year! That's 4 to 5 times faster, and we all know how valuable time is when it comes to property investing. Despite being often overlooked in favour of larger malls, these small retail hubs are showing themselves to be a solid investment, especially in turbulent times. I will mention though that historically, investor demand for neighbourhood centres here in Australia has climbed steadily since 2014. These smaller retail hubs tend to have lower price points and strong capital growth potential, so they attracted interest even pre-COVID. But when the lockdowns hit along with the online shopping surge, foot traffic pretty much disappeared in bigger city centre malls almost overnight. Despite universal rent drops from all the uncertainty, neighbourhood centres held up better, and it comes back to adaptability. With more households shifting to online spending, major malls built around department stores have struggled to pivot. Their large, inflexible formats don't align with how consumers now behave. When you compare that to convenience-based community hubs with supermarkets, specialty shops, and even healthcare services, these have performed much better. Their compact size and essential offerings cater perfectly to suburban communities and rapid delivery. And post-pandemic demand reflects that. Now, on top of adaptability, the pandemic has made local even more essential. The 20-minute neighbourhood concept has taken off, where residents can access goods and services within a 20-minute walk. And when your target customers are hyper-local, smaller community retail hubs get a natural boost in appeal and demand. CBRE has actually projected neighbourhood centres will dominate new retail supply and make up 68% of shopping centre development this year. So, could neighbourhood centres be the next big thing for property investors in our ever-changing world? In my opinion, neighbourhood retail is showing unique resilience and reliable returns, even in the middle of so much uncertainty. The data and trends are clear, but picking the right centres is probably the most important factor in success of your investment. So, if this is an area of interest for you, feel free to reach out to me. I've left my contact details in the description below. My goal is helping investors like you stay ahead of uncertainty through smart capital allocation. Cheers.